Hi, this is Nikki James, and this video I'm going to talk about cash required when you buy a house. So oftentimes we think about just the down payment, and that's important, of course, and I'll go through the different options there. But there is a couple of other things that we often don't think about that we need to budget for, and that's closing costs and reserves. And so I'm going to talk through each one of those. So let's start with down payment. Down payment can be as low as actually 3.5%. So that's more commonly known as an FHA loan, a Federal Housing Administration loan that allows as little as 3.5% down. Nationally, the numbers are anywhere around 548, lower in some counties. So you do need to check your particular county. 10% down is more common in the what we call conforming loan limits, where we have Fannie Mae and Freddie Mac buying the loans. Again, it's that 548 magical number. In the Silicon Valley, it's actually 822,000, but and in different areas, you need to check your area. But 10% down is common there. We do, I'm with Flagstar Bank, we do have some loans that allow actually 10% down up to $1.5 million loan amount for certain professions and or certain cities. So something to check with us there. But generally, you're going to be looking at, once you get into that jumbo market, to perhaps wanting to get to a 20% down payment. And in another video, I'll talk about the distinctions between when you put less than 20% down. We have a thing called mortgage insurance, and I'll talk about in depth what that is and how we calculate reserves and things around that. But let's just talk today about cash required. So we've got the down payment, however much. So if you're buying a $500,000 house, 10% down is $50,000. $1 million house, 20% down, $200,000. So closing costs vary greatly, and it depends on the city, it depends on the county, and it depends on the tradition. So for example, in the Bay Area, Santa Clara County is what we call a seller pay county, versus San Mateo is a buyer pay county. And it's just tradition, and the buyers pay for more of the closing costs in San Mateo versus Santa Clara. Now, of course, you at some point become a seller, so it's not a reason to say I'm only going to buy in San Mateo, because at some point you'll sell the house and you'll have to be the, in Santa Clara is a seller pay one. So just watch that. There are transfer taxes. Different counties have transfer taxes and different cities have them. Not all cities do, but some actually have some significant transfer taxes. So that's something to ask your realtor when you're putting in an offer. They should be letting you know what are the transfer taxes in that particular city. Oftentimes they're split with the seller. Sometimes they're paid by the seller, but it's just, you need to make sure that you check with them. So we tend to say 1.5% is a good rule of thumb budget for closing costs. It's not set in stone, but it's a good rule of thumb for you. All right, reserves. So what are reserves? In a conforming loan, again, that's the smaller loan amounts under 548 nationally. We just require 2 months of what we call PITA. That's your principal and interest, tax, and insurance. It's the housing payment. And most often, if you have a little bit in retirement, that covers it. You don't even hear the word reserves. We're not going to talk about it much. In the jumbo market, though, those larger loans, reserves are from 6, sometimes 12, in some cases 18 months, depending on the size of the loan and the loan to value. And in some cases, some of those reserves have to be what we call liquid non-retirement. In some loans, all of those reserves can be counted from your retirement. It doesn't mean to say that you have to spend your retirement. This is what we're looking at, is just what do you have left over after the close of escrow, that in the event you got into trouble on your mortgage, let's say you lost your job, something happened, you had a medical issue, how many months of reserves do you have before you'd be in having an issue? So that's the point of reserves. You don't have to do anything. You don't have to move them. If they're sitting in retirement, that's fine. They just sit there. We take a haircut. We take a discount. If you have 100,000 in retirement, we're probably only going to count 60 towards reserves, because if you had to access your retirement, you'd have to pay a penalty and taxes. 401ks count as reserves. If we are using 401ks for reserves in the jumbo world, we're going to ask you for your terms of withdrawal, and you get that from your plan administrator at your company. We just want to make sure that in the event of a hardship, they actually allow you to access your 401k. So that's it. That's basically the 3 things that you need to remember to budget. Don't forget those 2 things outside of down payment. It's often gets expensive. If you are putting less than 10% down, there are additional reserves. Those are tied to what we call impounds, and I'm going to go into that in a different video because it's a little bit more detailed. And I look forward to seeing you at my next video. Thanks.